So you've recently retired, you've left that W-2 paycheck behind, which is fantastic, but what you might not realize is that you've also walked away from the automatic tax safety net that your employer provided. You see, there's a hidden trap in the tax code that pretty much specifically targets retirees, but there's also a mathematical shield the IRS gives you to defeat it. Let's dive in. The threat we're talking about is called the underpayment of estimated tax penalty, and it's no joke. Recently, the interest rate the IRS charged for this peaked at a staggering 8%. Now, while it has come down a little bit since then, this is not just some small fine. It is a serious drain on your retirement savings.
And here's where the math really works against you. The penalty rate is sitting around 7%, right? Meanwhile, a typical high-yield savings account might be earning you, 4.5%? This creates a situation that financial folks call negative arbitrage. You are literally losing money by holding on to your own cash instead of just prepaying your taxes. In a way, the government is monetizing your procrastination.
Now, the really crucial point here is that this isn't a flat fee. Oh no. The IRS treats your underpayment like a high-interest loan, and they charge you interest that is compounded daily. So if you're just waiting until April 15th to pay the tax on your investment income or your IRA distributions, you're probably walking straight into this trap, and that penalty clock has been running against you for months.
So why is this all of a sudden a problem in retirement? Well, it's because your role has completely changed. You're not just an employee anymore, you are now the chief financial officer of your own life. Think about it. When you were working, your employer handled all of this for you automatically. See, the US has what's called a pay-as-you-go system, and your company's payroll department made sure you were compliant. But now, that automated shield is gone. For any income from pensions, investments, property sales, the responsibility to pay the IRS throughout the year is now 100% on you.
And here is one of the biggest bear traps in the entire system. The IRS calendar. It isn't symmetrical. Your first payment is due April 15th, fine. But the second payment, the one covering income you made in April and May, is due just 2 months later, on June 15th. So many people, they're exhausted from tax season, they assume they have another 3 months, they don't, and missing that deadline starts the penalty clock ticking right away. And this is not some informal process. The IRS requires you to calculate and pay these amounts using a very specific form, the 1040-ES. This is the official tool you have to use for managing your quarterly tax obligations and staying on the right side of that pay-as-you-go system.
Okay, so right about now, you're probably thinking, how on earth am I supposed to guess my income for the entire year? And that's a great question. The good news is, you don't have to. The IRS actually provides a set of rules that act like a mathematical shield, giving you absolute immunity from these penalties. And this is what we call the safe harbor rule.
But first, we have to clear up the single biggest misconception about this. Following the safe harbor rule protects you from the penalty, but it does not mean your tax bill is magically paid in full. If your income goes way up, you are still going to owe the rest of that tax in April. Think of the safe harbor as your get-out-of-jail-free card for any underpayment fines.
Okay, so there are two main safe harbor rules, and it all comes down to your adjusted gross income, or AGI, from the prior year. Your AGI is basically your gross income minus some specific deductions. If your prior year AGI was $150,000 or less, you get to use the 100% rule. But if it was over $150,000, you have to use the 110% rule. And believe me, this is a critical distinction that trips up a lot of high-income retirees.
Let's walk through an example. Let's say last year your total tax was just $10,000. But this year you sell a property, and your actual tax liability shoots up to $50,000. Well, as long as you pay that $10,000 from last year, spread up into 4 quarterly installments this year, you are completely shielded from penalties. You can just wait until next April to pay that other $40,000.
Now for the high-income rule. If your AGI last year was over $150,000, let's say it was $160,000, and your tax was $24,000, the bar gets raised. You have to pay 110% of that prior year's tax. So your total estimated payments for this year have to be at least $26,400 to activate that shield. If you only pay 100% in this case, you're actually exposed.
The IRS does give you a couple of other ways out.
For one, you can avoid the penalty if you end up owing less than $1,000 in April. You can also try to use the 90% rule, which means paying 90% of your current year's tax. But honestly, we call this the gambler's rule. It requires you to predict the future, and if you guess wrong by even a single dollar, the entire shield just collapses. The prior year rules are so much safer because they're based on fixed, historical numbers you can actually look up.
All right, so knowing the rules is one thing, but executing the payments correctly is a whole other ballgame. The best way to pay is online using the IRS Direct Pay system, but it has some quirks, let's say, that you need to know about to avoid making a mistake.
So when you get to the Direct Pay site, the most critical step is Step 2. Under Reason for Payment, you absolutely must select Estimated Tax. A lot of people mistakenly choose Balance Due, but that's for paying off old tax debts from past years. When you select Estimated Tax, you're telling the IRS you're paying forward for the current year, and it'll automatically apply the payment to your Form 1040-ES. Okay, here's the next trap. To verify your identity, the system asks you to choose a tax year. Now, intuitively, you might pick the current year. Don't do it. It will fail. You have to choose a prior year for which the IRS has already fully processed your return. Then you enter your information, and I mean your address and everything, exactly as it appeared on that specific return. And always, always, always request the email confirmation. That's your digital receipt.
Okay, now that you have the fundamentals down, let's look at a couple of really powerful, lesser-known strategies that can give you an even greater level of protection and flexibility. These are the pro moves.
This one is a fantastic loophole. See, the IRS treats your estimated payments as credited on the exact day they receive them. But tax withholding, like from a paycheck or an IRA distribution, is treated as if it were paid evenly throughout the entire year. This means if you realize in November that you've underpaid for the first 3 quarters, you can take a big IRA distribution in December, have a massive amount withheld for federal tax, and the IRS will retroactively apply that payment back to Q1, Q2, and Q3, completely wiping out any penalties. It's basically tax time travel.
But what about another really common scenario? What if you have very little income for most of the year, and then a huge income event, like a big sale, happens in the fourth quarter? The standard IRS calculation assumes your income was earned evenly, so it would penalize you for not paying up in those early quarters. So how do you fight that?
The solution is a specific part of Form 2010-10 called Schedule AI, which stands for the Annualized Income Installment Method. This form lets you demonstrate to the IRS exactly when you earned your income during the year. By proving that your income was lumpy and arrived late, you can completely eliminate the penalties for those earlier low-income quarters. Now, a word of warning. This form is notoriously complex, so this is one of those times it's probably best to work with a tax professional to get it right.
And finally, just remember that in certain situations, the IRS may waive the penalty altogether. This can happen if you retired after age 62 or became disabled and you had a good, reasonable cause for the underpayment. It can also apply if you were impacted by a federally declared disaster or some other unusual circumstance. You can request this waiver using Part 2 of that same Form 2210.
Look, the transition to retirement brings all these new financial responsibilities. The estimated tax penalty is a very real threat, but it's one you can completely neutralize with knowledge and a bit of planning. The safe harbor rule isn't just a guideline, it's a guaranteed mathematical shield. So the crucial question is, have you built yours?